What's up everybody, Nate here, and it's no secret that our entire economy has gone through a series of unprecedented changes over the last couple of years. We have seen extremely low interest rates, and we have seen a ton of money printing since pretty much the pandemic has started, and with all of that, our entire economy has boomed. But have you ever heard the phrase, the bigger they are, the harder they fall? Well, we might see a huge fall in 2022, one that we have never experienced before. It's true that our entire economy has exploded over the last couple of years, but now all of those things that have caused our economy to explode could now be contributing to one of the biggest market crashes that we have ever experienced in American history. And today I want to talk about this perfect storm that is starting to form right now and how that is going to affect our economy not only in 2022 but beyond. So the first thing we have to talk about is low interest rates and monetary policy. So if you remember all the way back in 2020, this is when the pandemic started, and this was a really scary time for Americans and of course their wallets. Nobody really knew what was going on, and that included the federal government, the Federal Reserve, and businesses. So with that being said, the federal government decided to step in and print a whole bunch of money. We had the HEROES Act, and we also had a lot of stimulus that was passed in order to get a lot of Americans and businesses and pretty much our entire economy through this unprecedented change in our economy. That meant that people could now go out and spend money, but on top of all of that, the Federal Reserve decided to step in and lower its benchmark interest rates. That made it really easy for a lot of money to circulate throughout our economy, a lot of that printed money to circulate, because now it was really easy for Americans to get a mortgage or for them to get an auto loan and for them to spend on credit cards, because all of those have a rate that is going down. So now it's super easy to get all of this money, and that included businesses. So now it was really easy to start a business and it was really easy to invest in one. But in 2022, a lot of that is starting to shift because now there's too much circulation and way too much money around our economy. So the Federal Reserve is reversing a lot of its monetary policy. And they're doing this to battle inflation. So in July 2022, inflation was around 8.5%. The Federal Reserve likes to keep it around 1 to maybe 3%. So it is highly elevated, the highest we have seen since around the 1980s. That means that prices for just about everything are going up by around 8.5% year over year. So Americans need a whole lot more money in order to buy all of the same things. This means that the Federal Reserve has to get aggressive on inflation, and what that means is raising their benchmark interest rate. So they have to control demand in our economy, and one of the ways that they do that is through their interest rates. When they lower them, like we saw in 2020 and in 2021, a lot of people are going to go out and spend money. Money is easy to come by and money is easy to spend because it's really cheap. You can save hundreds of dollars on your mortgage, for instance, because you don't have a really high interest rate. Like when I bought my home back at the start of the pandemic, interest rates were only around 2 to maybe 3%. So they were very, very low. I was saving hundreds of dollars, which means you could probably overspend on your mortgage, and a lot of people did that. So there's a lot of money circulating around all at once, and that's just one market, and we saw how the housing market has exploded over the last couple of years. Not only that, but businesses have expanded like crazy. We saw the stock market in 2021 hit new record highs. There was all of this excessive borrowing because debt was really easy to come by. You could basically take out a loan just like Americans did with a mortgage, and you could get hundreds of additional dollars, and it's not really going to cost you that much, especially for businesses. When you take out a loan like that, well, they're probably going to be able to make a lot of that money back, considering Americans had stimulus checks and they were going out and spending, so profits were also at record highs too. But like I said, when everything goes up like that, that causes inflation because there's just way too much money and way too much spending all at once, and businesses can't really keep that up forever, and they have to hire a whole bunch more people, which kind of pushes the inflation problem up even more because now you're paying more people and they're going out and spending more money, so now prices have to go up again, and you can see the problem. Federal Reserve can also do the opposite. They can raise their benchmark interest rates, bringing demand down, and that is exactly what they're doing in 2022. They have to bring inflation down, and one of the ways that they can do that from a price perspective is to basically make it a lot harder for people to spend money and and that includes for businesses. So with them raising their interest rates and basically reversing a lot of their monetary policy, that's going to hit pretty much every sector of our economy, from the housing market to Wall Street. That can hopefully slow down our economy enough to where people aren't going out and buying as many things, businesses can't hire as many people, and well, there's just going to be a lot less money circulating around. That means that prices can come down, the value of our money can basically stay the same, and your inflation problem is solved. Now, the second thing we have to talk about is huge unprofitable companies on the New York Stock Exchange. They are going to get hit the most with this changing economy and with these higher interest rate policies. There are a ton of companies on the New York Stock Exchange that, well, for lack of a better word, don't make any money. I mean, sure, they actually have some revenue, but they don't have any profits because their costs and their expenses are way too high. These companies are most likely going to go out of business and be the first ones to fall because of all of these interest rate hikes. Most likely, you're probably going to see a large string of bankruptcies from a lot of these companies. So in particular, a lot of your tech companies and your tech IPOs that have launched over the last couple of years, they probably aren't going to survive this new economic environment because, like I said, with inflation so high, that kind of creates a double whammy for businesses and of course consumers, because consumers can't go out and buy as many things. So these companies aren't making as much in sales, but these companies that don't make a lot of profit, they can stick around if they have a lot of investor interest, which means more capital and of course debt. Because interest rates are going up though, a lot of these companies can't take on new debt because taking on debt is way too expensive. And it's a lot harder for investors to put their money into those companies because, well, they aren't making any money. What we're going to see is a slowdown in a lot of these markets because all of these companies are going to have to diversify. They're going to have to figure out ways in order to make a profit in order to survive. I will say too that a lot of these companies that don't make a profit, well, the reason they don't make a profit is because having profits is kind of dangerous in a high inflationary environment. Profits basically mean that you have all of this money set to the side. Profits are something that investors don't really like to see because they want that money being used for something. So they want you to continue to, develop your business and to continue to grow as a company. If you have just a bunch of money sitting along the side, well, then it's just going to get eaten by inflation time after time. So it's almost an incentive for these companies to not have any profits. They want to continue to reinvest in their own business. They want to continue to up their costs, but as long as they have that investor money and debt to go off of, they can survive. That's going to be hard on our economy for the long run because now you don't have as many ideas. A lot of these companies have to slow down, so we're not going to have that innovation and that efficiency because all of these tech IPOs and a lot of other startups are going to start going away. And the third thing kind of connected to that is you're going to see unemployment rise because a lot of these companies are going to file for bankruptcy or they're going to disappear altogether, which means there's going to be a lot of jobs lost. Now, this is a pretty serious problem because when interest rates were really low over the last couple of years and debt was really easy to come by, these businesses expanded a lot. And to their credit, they really needed to because we had a lot of supply chain issues. Supply chain issues stem from the pandemic because we were basically shut down for a long period of time. Our entire economy wasn't really functioning, so we couldn't produce any goods. And it wasn't just the United States, it was countries all around the world, which was a pretty serious problem because nobody could get anything. Things eventually did pick back up, but we couldn't really get back to where we needed to. And now because we have inflation, companies can't really produce things fast enough because people need a lot more money and they're quitting because of the Great Resignation. They want better pay and better benefits. So that means that businesses have higher costs than they did before. So couple that with really high interest rates and no investor liquidity, that means they're going to shut down. And when they were hiring a lot of people in 2021, they were overpaying them and now they're overstaffed. So we are probably going to continue to see layoffs into 2022. Pretty much every major company on the New York Stock Exchange has reported or said that they're going to have some sort of layoffs or unemployment sometime in 2022. And if things continue to get more aggressive from the Federal Reserve or inflation goes up and costs continue to rise, we're probably going to see that even more into 2023. Overall, though, our labor market is pretty strong in the United States because you're still seeing job postings in the US and our unemployment rate is actually dropping. So this so far has not really hurt businesses, the rising interest rates and not a lot of investor liquidity. But if things continue to go higher and higher, then businesses are just not going to be able to pay all of their people, leading to higher unemployment and bankruptcies. In addition, you do have to read between the lines with our most recent jobs report because we have a lot of job postings, but job postings are beginning to shrink, meaning that businesses are looking ahead and they're realizing that they cannot continue to hire more people, and hiring freezes are getting more and more common amongst companies on the New York Stock Exchange. That means that our labor market is really competitive and it's going back to where it was pre-pandemic. A lot of Americans, though, are going to feel stuck, and it's going to be really hard to get a new job because you have to basically take what you can get, a complete reversal of what we saw in 2021. Americans were job hopping because they could get better pay, and businesses were willing to give them better pay because they had all of this investor money and debt to go off of, and inflation was still pretty low at the time. Money was very easy to come across, so they were paying people whatever they wanted to. Now in 2022, they have to be very careful about what they pay them, so Americans are basically going to only be able to take what they can get on the jobs front. And that leads me to number 4 and the final part of this entire puzzle, American spending. Now, consumer spending drives around 70% of our GDP. So if Americans are spending money, that basically means a lot of things. It means that prices are at a good level and that Americans have a lot of money. So that is a good thing for your economy. It means your GDP can expand and it means that your economy can expand. And right now, Americans continue to spend, but the problem is they're spending too much because prices are way too high. That means that Americans are losing and draining their savings accounts because everything costs so much and they have to spend that much in order to get basic necessities. And this stems from the pandemic too, because a lot of that stimulus drove a lot of Americans to overspend, which caused a lot of inflation. But now in 2022, they can't get all of the same things they could before. So a lot of Americans have a standard of living that they want to keep. So they're trying to spend and spend on credit cards. Credit card debt is also rising and recently hit a new record high as well. So Americans are going out and overspending right now and draining their savings accounts. So they have no money in order to protect themselves. Meanwhile, everything costs more and they have to have all of their basic necessities. All of this means that we could see one of the biggest crashes of our generation because you have a lot of businesses that are just going to flat out disappear. The government can't really step in anymore because they are trying to bring inflation down, and that is their number one goal. But we're running into a situation where Americans are not going to have any money because a lot of them fear that they're going to lose their job by the end of 2022, and that means they won't have any money to spend on anything. So a lot of businesses that aren't necessarily affected by a lot of these problems because they do have really solid profits are still going to be affected by them because now there isn't any consumer money flowing into them either. And you have a lot of economic shrinking, which is going to continue to affect businesses and consumers. Consumers aren't going to be able to go to the store and buy as many things because businesses are scaling back what they're producing, leading to more supply chain issues and in the short term, even higher inflation because there just isn't enough goods in order to meet demand. Supply is a way lower than what demand is. But now I want to hear from you on this issue. What do you think about one of the biggest generational crashes in history essentially coming to the United States sometime soon? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.